Good morning and welcome everybody to the latest in the IMAP webinar series. As we all virtualise, this has really become part of our lives, hasn't it? And for myself, I've found it a really worthwhile way of connecting with others. Today's session is really interesting, and I think the number of registrations that we've had is demonstration of the fact that for many people, the issue of volatility in investment portfolios has achieved a new importance and one which I'm really looking forward to listening to Deanne Baker on. I'm going to ask Amanda Munro, Chair of the IMAP Portfolio Management Group, to introduce Deanne and to manage the questions today. And I'd encourage you to participate with questions. At the bottom of your screen, if you run your cursor down to the screen, you'll see a little icon for Q&A. If you type your questions in there, the three of us will hear those, and Deanne will be in a position to respond to those during or post her presentation. Before I ask Amanda to introduce Deanne, let me just talk a little about the issues for COVID or coronavirus and how we at IMAP are managing those. Obviously for us, conferences have been a very significant way of drawing together advisors and fund managers, portfolio managers, and we've had to suspend our conferences, in fact terminate our roadshow in the middle. So what we've decided to do is to push our awards from June to August, and I'll talk more about the awards in just a moment, to move in our portfolio management conferences, which are one of our most important events, from August to November. And this year we'll be running it in Sydney and Melbourne, and potentially in Perth as well. But that's meant we've brought Investec back to September. Brings Investec to September gives us an opportunity to, in fact, take a couple of the sessions which we ran virtually at the roadshow, and then present those live. So we'll be talking more about that as we get closer to the event. And of course, from now on, webinars are, as normal, monthly. Let me talk briefly about the awards and encourage you to participate in those. The Managed Account Awards, this will be the third year. There are 5 asset classes: Aussie equities, small caps, fixed interest, international and multi-asset class. But to my mind, the one which I really encourage you to participate in, so either innovation or the Licensees Award. So the Licensee Award is for those licensees who've made managed accounts part of their advice practice. And the real focus of that award is how does our managed account reflect our investment philosophy? Winners previously have been Stanford Brown and Viridian, 2 organisations who've been, for whom managed accounts have been central to the way they're actually able to articulate advice to their clients. And the innovation category is a very broad category. What do you do that's innovative? Why is it innovative? And how does it advance managed accounts? And winners previously for that have been Elston, with the way that they manage communications with clients, and Praemium for their general approach to managed accounts. So now it's my pleasure to hand over to Amanda Munro, Chair of IMAP's Portfolio Management Group, to introduce today's session, today's speaker, and to manage the questions for today. And I encourage you to participate through the question process. Thanks, Amanda, and welcome, Deanne.
Thank you, Toby. Today we're going to be talking about managing volatility, and I guess this is something that is always part of the portfolio management process, but of course particularly pertinent at the moment when it's very much front of mind. Deanne Baker, I'm delighted to present today. She will be presenting a short presentation and answering questions. And she's a portfolio manager for multi-asset investments at Lonsec. As Toby said, we encourage you to ask questions, which you can do down the bottom. We'll probably leave them to the end. We've got plenty of time to ask questions and plenty of people on the line. Please don't be shy, I won't announce your name. Just ask any questions that you would like to. Deanne, over to you.
That's great. Thanks, Toby and Amanda, for having me. I'll just share my screen if I could. Okay, and thanks everyone for taking time out of your busy day to listen in. I don't think I'm alone saying that it's been a really difficult time to be managing investor capital throughout this period, particularly given the speed at which this correction's taken place in. Now, I'm not intending to cover what could be a very technical topic in great depth in the 20 to 30 minutes we've been allocated. Instead, I just wanted to give a few practical tips on managing multi-asset portfolios through volatile periods, and perhaps bring some colour to that with what we've been doing in our portfolios at Lonsec during this COVID-19 outbreak. I'm going to start by touching on the nature of volatility and why it's important from a portfolio construction perspective to understand how volatility behaves. Volatility or risk is a fact of life and certainly a part of investing. As investors, I'm sure you all know that you can't expect to earn a reward if you're not taking risk. However, the problem with volatility as a measure of risk is that it comes and goes with very little warning. You know, it tends to cluster in that periods of very low volatility are often followed by short, sharp episodes of high volatility or spikes. And the shift between a low regime to a high regime volatility can happen very, very quickly and really catch investors off guard. Here's the VIX index. It's the well-known CBOE index of implied volatility in the US equity market, otherwise known as the fear index. And if you have a look, it's averaged about 20 over the last 30 years, but as you can see, it's rarely at 20. You know, we tend to see very low levels of volatility, followed by very high levels and punctuated by extremely large spikes. If you look back to the 1990s, we saw very low volatility before the tech bubble burst. And then again, in the mid-2000s, very low levels before the GFC. And even recently as 2007, we saw record low levels of volatility in equity markets. Now, since 2017, we've had a couple of medium-term spikes around, fears of a US slowdown when the Fed over-tightened a touch, and also around the US-China trade war fears. But even then, volatility returned to very low levels just before the big one hit in mid-March on the back of COVID-19. And there we saw the VIX reach its highest level ever at 82.7. And that was higher than its peak even in the GFC. And while we often see and hear about volatility in equity markets in the news, a similar phenomenon occurs in bond markets and FX markets as well. And this is the MOVE index, which tracks the volatility in US Treasury yields. Again, you can see that periods of low volatility are often followed by very sharp spikes, which tend to come back down pretty quickly. But it's these low periods of volatility that can lull investors into a false sense of security. You start thinking times are good, risks are low. Maybe I'll start adding some more risk, by stretching into some higher yielding bonds or taking on more equity beta than perhaps you should. It's very difficult to predict when these spikes will occur or what the cause will be. It could be a pandemic, it could be an oil shock, terrorist attack, or a financial crisis. So the key message here is, don't assume that you'll be able to time the next spike in volatility, except that it will come at some point, and be prepared for it. Because once volatility spikes, it's often too late to readjust your portfolio. Now, here's the daily price movement of the ASX 300 from the start of February. And as you can see, daily price movements begin in a pretty normal range, only to rapidly increase in the last week of February and into March. You know, de-risking and going to cash in these types of environments can have very poor long-term outcomes for investors. So more often than not, the best thing to do is absolutely nothing in these periods. If you're trying to reposition your portfolio when the market's swinging up 6% one day, then down 10% the next day, it's really like flipping a coin than making a rational decision. The outcome is really going to be out of your control. Now, also a reminder that by being out of the market, you know, clients will risk missing out on the market rallies that tend to follow the market downturns and periods of high volatility. As we've seen, volatility spikes can end almost as quickly as they began. I'll touch on this a bit later, but we didn't trade at all over the first 2 weeks of March from an overall asset allocation perspective, other than realigning some of our hedges. So instead, we think the focus should come back to building a long-term structural portfolio that you're comfortable with. And that really comes back to your investment policy, your individual risk tolerances, and of course, diversification. One of the most important fundamentals of investing is diversification. And that is that you can improve your risk-adjusted performance by combining a range of asset classes that have correlations that are less than one. And the lower the correlation, the greater the benefit, which is why as multi-asset investors, we invest across equities, fixed income, real assets, and alternatives. For building a long-term portfolio strategic asset allocation, we do rely on long-term correlations between asset classes, as most investors do. You know, it's important to remember, however, that the correlations can be very unstable, and particularly so in periods of heightened volatility. Assets can become highly correlated when we least want them to be, and diversification can certainly fail over short periods of time. So while long-term correlation between assets is useful, you also really need to understand what's going on in the tail of those distributions as well. So what we do to supplement this is to use a macro factor analysis to help us understand how asset classes perform under different macro conditions. And we do this for other macro factors as well, including inflation, liquidity, growth, as well as volatility. Here's the output from our volatility factor model. It's based on historical data and shows the performance and correlation of each asset to volatility itself. Now, I've split up the results into periods when volatility is high, when it's neutral or normal range, and when it's low. And I've annualized the monthly results here, really just for greater effect. We wouldn't expect to see volatility remain in the high regime for 12 months. As we know, it tends to spike and then come back down. So don't expect to get these returns you're seeing on this page here from investing in these assets. You know, if we start with equities, you know, we intuitively know that equities perform very well when volatility is low, but perform very poorly when volatility is high. And if we look at the correlation of equities to volatility, we can also see that they become even more negatively correlated as volatility rises. On the other hand, if you look at assets such as bonds, gold, some foreign currencies such as the US dollar or Japanese yen, and even some hedge fund strategies typically do well when volatility is high. These assets become even more positively correlated to volatility as volatility rises. And that's really useful for portfolio construction purposes. So it's important to look at how each individual asset class correlates in a high volatility regime. And it's a good idea to have some allocation to those assets that are positively correlated to volatility. That is, their prices go up when volatility goes up. You think of these as almost your flight to quality assets, and make sure that you have some in your portfolio. It's for this reason that heading into COVID-19, we maintained an allocation to bonds, and that's despite the poor yield that was on offer. We also had an unhedged global equities allocation and a reasonable weight to alternatives, including gold. All of these assets tend to perform much better in periods of high volatility and offset some of the losses in other parts of your portfolio. And from our perspective, it was these positions that really helped protect investor capital in our portfolios during March. Periods of high volatility are often characterised by high news flow and can really drive strong emotion and often fear. And there can be a real impulse to feel like you have to do something or anything. And we certainly saw that in March, where almost every day we saw wild market swings. There was new policy announcements in terms of monetary and fiscal policy. There was new macro data releases, a whole host of information flooding in. And periods such as this are certainly not the time to be introducing active asset allocation decisions and processes if you don't already have one in place. If you do have an existing active process, what we would say is that it's really important to maintain perspective. It's important to ignore the noise and focus on what counts in terms of your investment process. For our multi-asset portfolios, we believe in a diversified portfolio approach across asset classes, and our focus is really on risk management. We aim to do this through a combination of active asset allocation decisions that are focused on managing risk, as well as active bottom-up investment selection. In terms of what we did during this period, the first thing we did was increase the frequency of our investment committee meetings. Typically, we run these meetings quarterly for asset allocation and manager selection. Over the last 8 weeks, we've been running those fortnightly. And that's really just to keep on top of what's happening in markets. And in line with that, we also ran our dynamic asset allocation and our risk models more frequently. And we've also been in regular contact with our underlying managers more regularly and trying to get a better feel from the risks and positioning coming from our bottom-up managers as well. So it's been a busy period for all. In terms of our dynamic asset allocation process, we're primarily concerned with avoiding risk and taking advantage of opportunities that come about when markets are at valuation extremes. So we see valuation as being one of the key drivers of asset class returns over the medium to the long term. And we supplement that with where we are in the business cycle, what are the monetary and fiscal policy settings, and momentum or sentiment in markets. As we know that asset prices and valuations can remain elevated or depressed for extended periods of time. To bring some life to that, here's how our global equity model evolved throughout the first quarter of 2020. We were defensively positioned coming into February with underweight positions in both Australian and global equities. Our models were indicating stretched valuations, and particularly in the US, while our cyclical indicators were starting to show some signs of improvements following the truce in the trade war and some Fed easing as well. So we ran our models again in late February, and we saw that valuations had really started to cheapen up over the course of just a week or so as equity markets plunged, and valuations moved to more neutral levels. But volatility was peaking, and we were conscious that our cyclical indicators had started to turn negative as well. So we didn't actually take any action at that time. Towards the middle of March, we ran our models again, and we decided at that point to rebalance back to our target weights, as our portfolios had drifted a fair way from our DAA targets just through market movements alone. So it wasn't really until early April when we reran the models again that we were more comfortable in adding back some risk to the portfolios. You can see valuations turned even more positive by then. However, the cycle had deteriorated even further. We moved to neutralise our underweight position in equities at that point. We certainly weren't trying to pick the bottom of the market. Rather, again, we went back to our process and taking into account our philosophy and our time frame, we felt this was a good time to start adding more risk back to the portfolio. And that can often be a good way of doing it too. During these periods, the first step could be to rebalance back to your target DAA weights, step back and reassess the situation again before making a more active decision in terms of repositioning the portfolio. Now, I also wanted to highlight that there is an upside to volatility as well. The good thing about volatility is that you often see a broad-based repricing of assets, and high-quality assets and asset classes that were once too expensive for you to consider now start to look attractive. For us, and given our focus on valuations, we're seeing many opportunities starting to open up. This chart here shows the Z scores for a range of equity market valuation measures, things like your typical PE ratio, price to sales, dividend yield, cyclical adjusted PE, etc. You know, just your common industry measures of value. On the vertical axis, greater than 0 is considered cheap, less than 0 is considered expensive. And we're talking in standard deviations here. So the thing to note is that most measures now are indicating a degree of cheapness in equity valuations, and some measures of value, particularly in places like the UK, are looking north of 2 standard deviations cheap. Now, obviously, there's still quite a lot of risk around, and while we've seen the price adjustment in these valuations, we haven't yet seen the full impact of the earnings response. So these values may not be as cheap as they first appear. But I just wanted to highlight that opportunities do emerge from these shakeout and volatility. It wasn't that long ago, perhaps 6 to 8 weeks ago, that all of these measures were predominantly on the negative side of the scale. You know, and there were very few opportunities from a valuation perspective. So it can be a good idea to use these periods to upgrade the quality of the assets, if possible. I wouldn't say we're overly bullish yet, and we certainly know that the fundamental and economic data coming out over the next quarter or so is going to be particularly awful. But if we take into account our investment time horizon and focus on investing in quality assets with strong balance sheets, we think that good opportunities are beginning to emerge. We're kind of focusing our research efforts at the moment in the areas of credit and some opportunities in equities as well. I should also mention that we do employ a multi-manager approach. And as I said before, we've really been increasing our contact with our underlying managers throughout this period. And what they've been telling us is that they too have been taking the opportunity to upgrade the quality of their assets in their portfolios as well. Some are telling us that there are stocks that they've always wanted to own but have simply been too expensive to buy. You know, they're now looking very attractive. So there's opportunities at all levels of the portfolio management at the moment. And finally, just a quick word on liquidity. We're seeing a lot of news in the press around the issues of industry super funds are facing due to their larger liquid positions. And they're certainly looking like forced sellers of their liquid assets thanks to the government's early release policy. I wouldn't say that's a major issue for managed accounts, given the fact that accessing those kind of assets has historically been more difficult, purely from a size and scale perspective. You really need to have a large amount of funds to make any meaningful allocation to an airport or a city office building directly. But increasingly, we're seeing illiquid assets being offered in more liquid forms, such as LITs and LICs, you know, which do have more appeal from a managed accounts perspective. I think the main issue for managed accounts is really around the opportunity cost of holding too many illiquids. The illiquidity premium is certainly a true premium in that you can and you should be rewarded for taking on the liquidity risk of longer dated assets. And if you can get access to it, then it's a great source of return over the long term, as the industry funds will tell you. But as with all good things, I think the most important thing is really portion control. If you have too many illiquid assets, you may not be able to take advantage of the new opportunities that arise. And again, I'm talking about being able to upgrade the quality of those assets following a volatility shakeout. And when thinking about liquidity, you know, we're not just talking about unlisted assets such as real estate or private equity, or private infrastructure. You should also consider including in that bucket of illiquid assets things like high yield, small caps, emerging markets, as liquidity in those kind of markets can evaporate very quickly, particularly when volatility rises. And while you may be able to sell those assets, you may incur a significant haircut if you do. So really, it just comes down to having sufficient liquidity in your portfolio to be able to take advantage of those opportunities that do arise. Excuse me. So just stepping back now and summarising the key takeouts from today. I think the first thing is really just to accept that volatility is part of investing. You may not know when a spike in volatility may occur or what may cause it, but know that every so often there will be a big spike and be prepared for it. From a strategic asset allocation point of view, that means holding truly diversifying assets. Now that includes a mix of assets that are likely to do well in volatile times. If you are making active asset allocation decisions, you know, have a robust investment framework in place and stick to it. During periods of heightened volatility is not the time to be making active decisions on the fly. And be open to the opportunities that will emerge, and they will emerge. And just finally, ensure there's enough liquidity in your portfolio to take advantage of those opportunities as they do arise. I'm going to end there and hand back to Amanda. I think we do have a few more minutes left for any questions. Thank you.
Thank you, Deanne. It's covered a lot of information very succinctly there. I do have a few questions, and there's a few questions from the audience as well. Maybe it would be helpful if we could go back through to the beginning of the slides to speak to them. If we go back to the VIX index that you showed initially, and the MOVE index as well, that you hear a lot less about, I wondered if you could just explain how that is calculated and how that is a different measure to, say, a standard deviation or other volatility measures that people look at.
Yeah, sure. So VIX is implied volatility, or I guess the market's expectation of volatility. It's based on option pricing. So I guess it's almost a forward-looking measure of what the market believes risk is going to be over the next 30 days. Standard deviation, on the other hand, is I guess more backward-looking in that it measures the dispersion of an asset class returns over a period. And that can be applied to any asset class or any return series, really. VIX is more specific to equity markets, and MOVE, on the other hand, is specific to US Treasuries. So they're quite defined measures of risk there.
And can one invest in VIX directly, or is it something that you need to gain exposure to?
I believe there are a number of ETFs out there and ways to get exposure to the VIX. I'm not quite sure if there's any exposure available in the Australian market, but I know there is in the US. Certainly ways to access that if you wanted to take a bet on volatility itself, yes.
All right. And again, I guess the next slide, I think it's the next slide on correlations. There's a couple of questions on that one. Oh, sorry, it's not even the next slide, is it? Page 8. I wondered if you could just explain, I guess, you know, if you have a correlation of less than 1, that would mean, for instance, that the assets would be, one would go up when the other goes down in general, I guess. Is that right?
Yeah, that's right.
Yep.
And, sorry.
My other question is, what time frame would those, you know, these are long-term correlations, you said, what time frame would you be looking at for those correlations?
Yeah, so these are the correlations that I should have pointed that out. These are the correlations we use in our long-term strategic asset allocation. So they're rolling 12-month correlations, but it's over a very long period of time, 30 to 40 years where the data is available. So this is the long-term correlation of asset classes. And as you said, you know, a negative correlation is usually good for portfolio construction. However, you know, correlations aren't stable, and that correlation can certainly turn positive in times of volatility, as we've seen recently as well.
All right. Okay.
My question, if I can interrupt, man, my question about this slide is this correlation of asset class returns or correlation of volatility?
This is the asset class correlations of asset classes between each other. So how Australian equities correlates to each of the other asset classes that you would build your portfolio with.
But the returns of from each of those asset classes.
Yes, correct.
Yeah. And you've got actually a number of, I mean, you've got a whole lot of asset classes there. And I was wondering if you could go into a bit more color about how you use, say, currency. Currency is a great example, perhaps, or commodities or something like that to, you know, try and push out your efficient frontier.
Yeah, look, I mean, adding any asset with correlations less than one, you can certainly do that, and that's why you know, it's important to do have these long-term correlations when you're building your long-term structural portfolio. I think the point I'm trying to make is that this is one number, and while you do need it to build your long-term portfolio, it's also important to understand that there will be periods of time when this number doesn't hold true, and they're often the times when you need it the most, which is internet times of high volatility. So certain asset classes become more correlated during periods of high volatility. Yeah, and some asset classes become less correlated during periods of high volatility. So I think that's the point I'm trying to make from these two slides here.
All right, I think that sounds clear enough. And another question I've had, I guess, is relating to your low, medium, high volatility regimes. I want to ask this question, although I might hopefully you'll be able to answer it. Given the significant differences across volatility regimes, the low, medium and high, could this clustering information be incorporated in your asset allocation deliberations?
So the thing to point out about this sheet is that it tells you nothing or no information about how long we're in each of the low, the neutral or the high volatility regimes. So while I've used monthly numbers here and I've annualized that to get a minus 43.8% return for equities, for that to hold true, volatility would have to be high for a period of 12 months. As we know, volatility doesn't work like that. It tends to spike and then come back down. So in reality, you're probably going to get 1 month's worth of high vol of returns, you know, in that high volatility regime before it drops back to a more neutral level. So you can see the kind of neutral level is more aligned to the long-term expectations, not always, but more aligned to the long-term return expectations of the asset class itself, because volatility tends to be in the low to neutral range more often than it's in the high volatility range.
Yeah, and actually I wanted to ask one about the low. In your initial slide, you showed that the spikes often occur after a period of low and even decreasing volatility. And I'm wondering if you could somehow use that signal as, you know, in sort of pulling back your growth exposures or your more risky exposures.
Yeah, look, I'd be cautious in doing that. I think the way we factor this in is more from a structural perspective and just understanding that you do need some asset classes that behave like this in your portfolio to offset assets in your portfolio that are obviously going to do poorly in this environment. Using it as a market timing signal, I would be cautious. As I said earlier, we don't know what's going to drive the next spike in volatility. It can be, you know, it could be maybe a recession, and in that maybe you can see that coming in terms of you see cyclical indicators kind of decline and you kind of move into that period that way. But if we do get another 87 stock market crash, or, you know, one of those really sharp spikes in volatility, even the COVID-19, you know, that came from pretty much nowhere, unless you were, you know, expecting that to really have the severe impact it had back in January. nobody was really expecting that kind of volatility to spike that much in those few days. So if you think you've got special insight, by all means, but I would suggest that it's very difficult to have special insight about volatility. And there are certainly volatility traders out there who think they can. We're not those, we're long-term investors. So we see this as more of a structural tool and making sure that we've got allocations to these asset classes in our portfolios to help cushion the losses from our equity portfolio during those times.
What about using, you know, volatility factor investing in your portfolios?
Yeah, low volatility as a factor is something we like, and we use 2 low vol strategies in our portfolios. We use one in our Aussie equity component and also one in our emerging market bucket as well. We think that low volatility investing or buying stocks with a low historical standard deviation, you know, really sit well with our risk control philosophy. And that does tend to protect on the downside, as we saw in March as well. And it really comes down to that concept of winning over the long term by not losing as much, which is aligned to the way we construct portfolios and think about things.
So would you invest more now when, you know, you're dipping a toe back in more risk exposure? Maybe look to hedge some of that.
I'm thinking more from a structural perspective. You can certainly seek to time these factors if you want to. We like to have some in there as, I guess, a risk measure for things that may occur. But in terms of timing it, yeah, you again, you need some special insight, and market timing is difficult. I think we just like the exposure in terms of the downside protection it gives us if and when volatility does spike. We're not trying to predict when volatility will spike. And it does protect well. We saw in March that low volatility and the growth factors were actually the 2 factors that outperformed the most. But, you know, we recognise it's one style out of many, you know, and we like to have a multi-manager approach. So we combine a number of different styles in our portfolio construction, just not to put all our eggs in one basket, and really manage exposures to different styles as well, such as value and growth.
I've had a question about the type of recovery you see. I've seen L's and U's and V's, and perhaps there's a suggestion of a W here as well. Looking at your Z scores, everything looks like it's amazingly good value. But, you know, as someone has pointed out, there's a lot of uncertainty about the E number in your PE. And I guess, you know, you always see E's go down as you move towards reporting season anyway. But I was wondering, you know, how bullish Lonsec is feeling about the market at the moment. And, you know, would you choose a letter to describe the shape of the recovery?
We you know, our investment committee meetings, we do talk a lot about letters. And what we kind of settled on was more, less than a letter, more like a bath. So we're thinking of a bath shape when we think about this recovery. Maybe an extended U, and one of those fancy baths that starts up high and kind of resettles at a lower level.
Knobbles at the bottom.
Nice 4-foot baths, yeah. So that's where we think we're probably going to get to. But yeah, as I said, there's a lot of uncertainty. There's a lot of supply and demand kind of side issues that really need to be resolved. And we won't know the answer of those kind of things until we see how long this lockdowns will remain in place. I guess in terms of overall bullishness, we're neutral at the moment. We're neutral equities. As I said, we were kind of underweight leading into the start of the year. Now we've moved to a neutral position. We're looking for opportunities to add risk, but at the same time, we are conscious that the data flow is going to be quite bad. So we're keeping an eye on a few different areas at the moment.
Yeah, all right. So, I mean, this rally at the moment you view as perhaps somewhat of a false dawn's probably a strong term, but you know, that it's going to be volatile down the bottom for a little while before we get some clarity, I guess, about the earnings and the hit to the economy, I guess.
I think we're over our investment horizon and our DAA process tends to think about an 18 months to 3 year horizon. I think valuations will be higher at that period, which is why we've added some risk back to the portfolio. What happens between now and the next 6 months, we think is there could be, you know, a further fall. It could go sideways. We're just not willing to pick the shorter term directions. We're not short term market timers. We do have a longer term focus in our process.
Just a quick question. I was wondering as well, like, have you seen active managers performing versus index during this period?
Yeah, so our active managers for the most part have outperformed, and this is what we're paying them for, right? So we're pleased to see that. There has been some, I guess, some style specific nuances to that as well. Value managers have obviously, which is a surprise, you normally expect value to do quite well in these kind of risk-off events. They didn't. Value didn't do well at all. However, our growth managers did quite well. Our low volatility managers did quite well. So on the whole, most of our active managers did quite well, and certainly those that have a risk control element in their portfolios, that is, they can go to cash or can invest in other assets, have certainly protected our portfolios over this period.
Speaking of cash, actually, you know, I was wondering what you feel is a reasonable allocation to cash at the moment.
So again, it depends on your risk profile and your investor, your investment policy itself. I guess if you, in terms of active position to cash, I guess we are slightly underweight cash. We've been using that cash to kind of buy some equities, as I said, to neutralise our equity position. So we're slightly underweight in terms of our cash position more generally. Yeah.
Okay. Yeah. And can we just talk about fixed interest for a second as well? It's a kind of a more broad question than just volatility, but on the bond fund liquidity and the probability of perhaps frozen funds.
Sorry, the
bond fund liquidity and the probability of, I guess, freezing up or widening of spreads and redemptions and so on.
Yeah. So I guess we really saw some severe issues in the bond markets. Kind of that first week of March, there was an enormous amount of selling, even in the most liquid parts of the market, US Treasuries, which was really just a liquidity event. People were selling pretty much whatever they could out of their portfolios, and that included some of these typically defensive assets as well. So liquidity, you know, certainly did dry up, and we saw credit spreads widen. And certainly a lot of liquidity issues at the higher end of the risk spectrum in credit markets. The central bank has since stepped in, obviously. The RBA has stepped in as well, the Fed stepped in, and it's really kind of provided a floor to those kind of liquidity issues that we were seeing. And those markets appear to have stabilised quite a lot. And as a result of that, I guess trading those securities has improved as well. And we've seen kind of the buy-sell spreads from a lot of managers that, you know, had increased during that period are starting to come back down too. So we're seeing much more, I guess, functioning markets in terms of bonds and credit, which is you know, a good thing for portfolio construction and diversification as well. So.
And what about sovereign debt? So do you have a view that that this will have an effect on fixed income or bonds, that there'll be any, you know, I suppose in GFC style sovereign debt blowouts, or, you know, are you avoiding those risks at the moment? Or if rates are so low that they'll be able to service them anyway?
I guess our view is that we are expecting, I guess, low bond yields for you know, quite a period of time. We're not expecting bond yields to be rising anytime soon. And central banks have told us, you know, that's going to be the case. They're going to keep their curves flat, and they're going to keep buying securities to ensure that that's the case. in terms of how we're using that in portfolio construction, we are trying to think about, we're going to get no yield from those kind of securities over the long term. Are we going to get less protection than what we may have had in the past in terms of kind of those risk-off periods? So we are thinking about how we use other assets, and some of those are the ones I've mentioned already in terms of gold and FX, to kind of supplement our risk-off kind of or flight to quality kind of strategy as well.
All right. Oh, here we are. I knew that. Speaking of gold, how would you gain your gold exposure, and you know, in your various risk tolerance portfolios, what type of percentage would you allocate to gold, and how's that changed, I guess, over time as well?
Yeah, so gold's a fairly new allocation for us. So I guess we kind of added that about a month ago, when we had some concerns around our hedge fund strategies as a hedge. We saw some of the quantitative hedge fund strategies we were using, some of the underlying strategies became highly correlated. So we weren't comfortable that was going to provide the protection we needed in our portfolio. So we added some gold at that point. We've chosen a gold bullion exposure. We wanted the direct exposure to gold rather than going through a gold miner or something like that. And we've allocated, I think it's about 3% to the growth portfolio. So it's not a huge allocation, but it is meaningful, and it did add value for us as we went through that period as well.
Excellent. I just wanted to go back as well to talked about active managers. And I think maybe this is even growth managers in particular, the question refers to, but the reasons that they did well. In fact, yes, did value managers outperform the index on average as well as the growth managers? And if so, what were what aspects of that drove them to perform better, do you think?
Well, I think the value managers in our portfolio, we kind of have a deep value contrarian manager, and you know, those kind of managers, you know, and we know value as a style hasn't performed very well over the last 10 years. So, you know, the low interest rate environment really has impacted those managers, and this correction, I guess, where you would normally expect these value managers generally to do well, it just didn't happen. So, you know, growth managers tended to be invested in those parts of the market that didn't sell off quite as heavily as well. You know, they invested in kind of the tech stocks and those kind of securities that you know, weren't as impacted as COVID-19 as some of perhaps the places value managers would tend to hunt in. So it's really an anomaly. We would normally expect growth managers to have come off more, but it's really due to the crisis itself and how that kind of the sectors and the securities that really have been most impacted by COVID-19 tend to not be places where growth managers tend to hunt. So.
Yes, it's a great bit of marketing for the active managers this current period, because you know they were trying to defend, you know, their fees, and you know, this has just really helped them along, I think. Just one question that you touched on, you know, unlisted assets. In fact, talking about super redemptions in general, but unlisted assets in particular. The extent to which, you know, the smoothing effect of having an unlisted asset is artificial. So something like Heathrow Airport, for example, which is a private asset, it seems disingenuous to say that it is a less volatile asset than a comp like Sydney Airport, Auckland Airport, or something like that, which are both listed. Now, I guess, would it be your view that, I mean, that effectively they are the same volatility, or is it, you know, the value that the end investor receives and should say that Heathrow is a less volatile asset because it doesn't trade every day, so it is inherently less. What is your way that you would speak to that?
Yeah, I think that's right. We don't invest in kind of unlisted assets in our managed accounts at the moment, but we do in some of our client and our paper portfolios, and we really don't see a lot of difference in terms of the true underlying volatility of those kind of assets. So when we're building our strategic asset allocations, we do make an upward adjustment to the volatility level of unlisted assets to really make them similar to the listed market. Maybe not all the way, but bring it back closer. Otherwise, our optimizer just really loves those kind of assets where you've got low, high returns and low volatility, and tries to fill your portfolio for them. So, we certainly make adjustments and think that there's the same kind of volatility in both of those kind of assets.
And just one final question, talking about your dynamic asset allocation. I was wondering how much that was a quantitative assessment and how much this is an art, because those factors that you talked about, the valuation, the policy or liquidity and the momentum, I guess each of those factors, particularly things like the policy at the moment, for example, or momentum prior to that, will dominate the other factors. So I was wondering how much you could really quantify that process, or how much you need to sort of get boys' heads around a table and try and ride the wave.
Yeah, you're exactly right. And I guess the way we do it is we have quantitative models, which are linked to daily price series and macro series that we get from Bloomberg and those kind of things. But that kind of forms the basis of our discussions. But then we do have, a number of people sitting around a table in terms of the asset allocation team members, and we get external experts in as well. We have a capital markets expert, as well as a longer term kind of macro thinker who brings a lot of insight in terms of what central banks are doing to our discussions as well. So we also get our research heads and our portfolio managers and our CIO around a table. So a lot of it is art, I guess, in the end. So if you just ran our quantitative models purely as they are, you get probably quite different results to what you would once you apply, I guess, our qualitative overlay.
Yeah, no, I can see that, especially at the moment, which I guess is why you've had to have this increased frequency of meetings.
Yeah.
Look, we're running out of time, and I've asked you a lot of the questions that have popped up. A few of them, I think it would be great. We're going to put the presentation up on the IMAT website to have a little bit of explanation around some of the slides, which is quite complex, I think. But I think explaining, especially some of the more data dense slides, because there's a few quite deep questions sort of here asking to explain some of the information you put up, and I think there's some quite interested parties there. So we'll include some notes with the slides when we put them up on the IMAT website. Thanks, Deanne. That was really interesting. I learned a lot there, and I hope everyone else did too. I can see that the participants number has stayed steady the whole time, so so everyone is still online. Yeah, we'll put up the presentation, and if you have any questions for Deanne, we would be happy to forward them on to her. Thanks.
Look, Amanda and Deanne, thank you very much for your presentation today. It's a complex topic, and I think, as Amanda said, the questions which came in illustrated the degree of interest in the complexity of this as part of portfolio construction. So thank you very much for attending today. And just a reminder that participating in the awards is something that I'm sure you will get value out of, and which gives us an opportunity to recognise best practice in managed accounts, an $80 billion part of the advice profession. Closing date for the awards is 26th of June, and the entry forms are on our website, so plenty of time, but I would encourage you to participate. So thanks very much for attending today. It's been our pleasure, and we'll look forward to you joining us for our next webinar in May. Thank you.